Hello and welcome to Charts and Chat for July 9th of 2023. This is Eric Boyce, CFA, President, CEO, and Chief Investment Officer for Boyce & Associates Wealth Consulting. Well, as we start the chart pack this week, it's worth noting that things have not gone nearly as bad as we thought they were. We've talked about this a little bit over the last few weeks, but coming into the year, we were certainly expecting a recession or at least a slowdown by now. And so far, the data, by and large, has been, better than would have been expected. Here's some charts from Charlie Bolello that he puts in his weekly pack that I thought were great for repurposing here because it kind of gives us a sense of where the sentiment was at the end of last year. And clearly, in the upper left-hand corner, a overwhelming majority of respondents felt like we were either in a recession or getting ready to head into one. So that was pretty well entrenched. University of Michigan consumer sentiment was below 60 for a record 8 straight months, which was really terrible sentiment. Inflation expectations were not great, and economic expectations were not that great either. And then here in the lower left, you can see that really for the first time in a long time that Wall Street analysts were expecting a down year for stocks, and that clearly has not played out that way. And again, there are a few reasons why there is some softness in the margin here, and I think there's still an overly abundant amount of optimism in at least the investment markets, but we've had a lot of money trying to chase these returns in the first half, and the market still lacks a lot of breadth, but eventually economic data, I think, does catch up with us a little bit. The question remains as to whether we're going to have a soft landing or whether we're going to have some type of mild recession. I think, honestly, that stands as a worst case scenario, as a mild recession. I do think that there are, there are just not enough imbalances out there right now that would create a kind of a catastrophic set of circumstances for us. But, let's be clear, there are things on the margin that cannot be anticipated. We have the resumption of the payment of student loans, and we've got some charts on that. We also have the risk of a UPS strike, which would be highly disruptive for supply chains, for consumer activity, et cetera. And then we obviously have the second quarter earnings season, which is literally on our doorstep right now. And so we'll learn a lot here in the coming weeks as far as what the CEOs are thinking. But, looking at this data, clearly we were not expecting, kind of the environment that we've had. But we still have, some things that we need to pay attention to. This is some other information from Charlie's pack this week that, kind of makes you scratch your head and wonder. We had the failure of the second, third, and fourth largest banks in history, as you see there on this chart, on this table rather, highlighted in blue. And, who would have thought that the market would have shrugged that off? You think about those of us that are old enough to remember 2008, and I remember it extremely vividly, Washington Mutual, and there were several others on this list that failed in '08 as well. But that was a fairly cataclysmic event. And so we have First Republic, Silicon Valley, which probably kind of carries the nameplate for what happened this spring, but Signature Bank as well, a little bit lesser known. But these things, when they happened, and the Fed, FDIC stepped in to backstop all depositors, and it really kind of put this artificial calming on the rest of the market. To the point earlier about some of the elements of the economy that have tracked better than we would have thought at the beginning of the year, this is certainly one. This is the Institute for Supply Management Services Purchasing Manager Index, or PMI. And so, just to be clear, there's both a services PMI and there's a manufacturing PMI, and they were going in dramatically different directions. But this is data that was clearly tracking lower throughout 2022 as we saw the inflationary pressures and hit, and then services, overall services activity being lower. But lately the data has been better than expected. Services does matter a bit more than manufacturing does in terms of its weight in the total economy. But there are other things with regard to manufacturing that are also important that kind of give us leading indicators of where the economy is going. But clearly anything above 50 here represents expansion. And so as we talk about the GDP or the economic growth figure, and we've got some charts on that coming up too, that this is symptomatic of very relatively slow growth, which we saw in the first quarter, and now we're beginning to see a lot of estimates for growth in the second quarter of around 2%. And we'll get that data. We'll get the first reading of second quarter GDP at the end of this month. But right now, this particular data series is more positive than we would have thought, frankly. Now let's contrast the services PMI with manufacturing. Now, as you look at this chart, it should be clear and obvious that manufacturing is in a slump. In fact, you could argue that we're in a manufacturing recession right now. But like I said, services matter a bit more than manufacturing does in terms of its weight in the economy. And so clearly services has been tracking better. But oddly enough, because of this is where we're seeing the preponderance of our inflation is in the services side. Manufacturing inflation has gone down. The admittedly transitory effects of supply chain disruptions have kind of whittled away. There's some obviously latent inflation that's still embedded in the manufacturing, but it's clearly embedded in services in terms of wages. And we'll see that in a little bit. Here we have the kind of the evolution, if you will, of the Atlanta Federal Reserve's GDP now estimate. And so I put Atlanta Fed's data out here because they've actually done a really good job of kind of predicting economic growth. And so right now they're looking at basically about 2.1% economic growth for the second quarter. And you can see in that blue line where the consensus lies, and consensus numbers have come up again, as we've kind of gone through, we've kind of cycled past the Silicon Valley, bank issue, which we just talked about. These estimates have come up. The feeling that, this almost this Pollyanna feeling that, oh, well, everything is going to be great, that these estimates have come up. And, again, you can't make any argument about, tracking towards recession. If you just look at it on its face, if we had, over 2% economic growth for the first quarter, and if we have 2.1% in the second quarter, that's certainly not something that you'd expect if you were standing on the edge of a recessionary cliff. And I think, this type of data and this type of sentiment that feeds into these estimates kind of gives us a little bit more comfort with where I was going earlier, that perhaps we're heading for a soft landing or maybe a mild recession here coming up. On this chart, we have personal consumption expenditures. This is the price index at 12-month change. We can see here Fed's target is 2%, remains 2%. I still believe it's going to take us a while to get there. And that's why there's some growing anxiety as far as what the Fed's going to do with interest rates. They did pause this last month after raising 10 consecutive meetings. And then, the expectation later on this month is that we will get another 25 basis point increase. And, that there is a feeling out there that if these prices remain somewhat sticky, that we could get more rate increases. And, if you'd gone back 60 days ago, that would have absolutely not been the case. And so when you look at inflation here, you see it on the core basis kind of sticky. We know that if you back out the housing components or rents, that this number is probably a little bit lower than that, but they're still well above the Fed's inflation target. And so You have to assume in your forward thinking that the Fed is going to remain vigilant in trying to bring inflation down. But the problem is that a lot of monetary policy works at a lag. And I've said this a lot, that it's going to take time to see these things filter through the economy. And honestly, what I think we have seen is we had such a massive dislocation during the pandemic of resources, supply chain, labor, all of this stuff happening. It's like dropping a rock into a calm pond. And you see the ripple effects, or when you first drop it in, the ripple effects are pretty dramatic, but then they kind of even out over time, and then the water becomes calm again. And I think we're in the middle of those ripple effects beginning to work themselves out. And I think that has a lot to do why this first half of the year didn't completely play out like we had thought it would. And so we're still dealing with the working out of these dislocations. But just kind of putting a bow on this slide here, core PCE still relatively flat. We've got about 2.5 percentage points of inflation to go on PCE to get down to the Fed's target. Here we have some inflation expectations. So this is from the Federal Reserve Bank of New York. 1 year ahead, still looking at 4%. We do see where that's come down quite a bit and tremendously over the last year. So directionally, all of this is moving in the right direction. We want the 1 year ahead to come down. We do, interestingly enough, and we've seen this over the last few months here, that both the 3 and the 5 year inflation expectations are migrating back up to 3%, which clearly, if you think about it, is at odds with where the Fed wants it to go. And so, again, this anxiety that's beginning to build on the margin as far as, well, how far will the Fed go, and will the Fed be tone deaf to the pace of current inflation to the point of eventually driving a harder soft landing or driving a harder recession. And I think that is probably one of the biggest risks over the next 6 months is there going to be a policy mistake because the Fed is keeping on the gas, keeping its foot on the gas here. This chart from Bolello, we've got market expectations for the Fed funds rate. This is looking out into January of 2025. And so these estimates are as of the past month. And so it reflects relatively current thinking here that, we were roughly 5%, looking about another 25 basis points. And then, as you get towards December and January of next year, that's when you perhaps begin to see the first rate decreases, eventually going down to around 4% here by January of 2025. And you think about it. I mean, the estimates for inflation that we saw in the prior chart are still looking for about 3, and so you'd expect Fed funds rates to be reasonably above the rate of inflation, so that you have positive real yields on even short-term investments, which is typically the case. And so, this is all kind of playing out as if 2024 is going to be that softer economic year for us. Here we have some reasons, that we can point to as far as like why at least the labor market's good. When you think about why the economy is a little bit better than expected. The labor market has been stubbornly strong. I will tell you that there are chinks in that armor, though, that we are seeing, and we'll talk about those. But right here, we've got, essentially labor supply, which is a problem. And so it's been tough to find workers because you got retirees that have accelerated. We've had some charts on this before, but ever since the pandemic, we've had a real spike in retirees, and those folks really haven't come back into the market. And so you see where we stand relative to the trend line there. And also we've got foreign-born workers that are tracking well below where we've been. Some of that has to do with some kind of tighter immigration policies, but obviously the pandemic put a wedge into that because nobody was making it cross-border, and that we just haven't picked up. So labor supply has clearly been one reason why that labor market remains relatively strong. We have some more labor data on this slide. On the left-hand side, we've got the consecutive number of months of growing non-farm payrolls, currently at 30 months. That is actually fairly impressive in its own right. Again, something you wouldn't expect if you're on the edge of recession, but it has in fact been true. You got the unemployment rate, which ticked slightly to 3.6, but you can see that remains at roughly a 53 year low. So labor's fairly strong here, and we did get the labor data this past week for June, and we added 209,000 jobs, which is below estimates. We had job openings, which were down a little bit month over month to about 10 million. We also had a drop in hours worked, and we had an uptick in new applications for unemployment insurance. And so, where we see here, this data is fairly strong, but we're seeing some of that froth being taken off. Here we have job openings. You can see the trend. It has the appearance of some slight moderation here. Certainly 1 month to the next, we had 9.8 million job openings versus 10.3 million in May. And so you can see this general trend of moderation as you look over the last year and a half. Here we have the 209,000 jobs that were added in June. You can see that how that tracks relative to the pre-pandemic average. So again, labor is still on a relative basis to before the pandemic, still relatively strong, but you can see here that it is weakening ever so slightly. And I think that's the real operative description here, is that labor is not falling off a cliff. We're not seeing these dramatic shifts in labor, but it is happening ever so gradual. We have the real average hourly earnings, which I will tell you in a positive sense, we have seen the first positive real average hourly earnings growth since March 2021. And you can see that we've had, according to Charlie Bolello's work here, 25 consecutive months of negative real wage growth. And so, that is positive to see wage growth. And so essentially wages are growing faster than inflation for the first time. That's good for, net savings and consumptions if it can be sustained. But that's the real question of whether it can be sustained. Here we have hourly wages looking at leisure and hospitality workers as well as all private. Again, we are still tracking wage rates that are higher than before the pandemic. They have come down. I think they probably are going to be, maybe a little bit more sticky and maybe a little bit more protracted in how they, edge down from here based on what we've been watching lately. Here's something I thought was really interesting as it relates to average hourly earnings. So you can see here in the black line, you get that hourly earnings. And just as we saw on that prior chart, this number is moving down. But the correlation between that and the ISM Services Prices Paid Index, and we talked about the ISM a few slides ago, but you see prices paid are going down. You think about this, if you're paying less for inputs, it does have a correlation to what your earnings are that you pay your employees, your workers. And so given this positive relationship, on this particular line, we've advanced the ISM Services Prices Paid Index by 5 months here. that you would expect our average hourly earnings to come down. And this is what I talked about on that last slide. As you look ahead, even though average hourly earnings growth is now positive, real average earnings are positive now, that trend may not continue. Corporate profit margins, we've seen some notable, upticks in various parts of the market lately, and I think margins, by and large this year, at least in the first quarter, have been better than we thought they were going to be, but they are coming down, and so this ties directly back into labor because for most companies, labor is going to be your major cost component, and so the struggle here is maintaining what you can do on cost containment to hold your margins. But as you have these wages now that are growing faster than inflation, it's going to put pressure on your margins. Yeah, I have a little bit of a busy chart here, but retail sales, we talk about the consumer and overall spending. We've got retail sales that we know are in decline. We've got a little bit of data on credit coming up, but you look at this chart, retail sales is a component of consumption, which represents 2/3 to 70% of the economy, and probably doesn't get enough mention because this all ties back into retail inventories. Are you properly stocked? And so sometimes you get a bump in economic growth because you may go into a period where you're very thin on stock, and so you've got to rebuild that stock, and it's a boost to economic growth. But when you have retail sales that are down, then you want to curb your production. And I think we're at that point now, and I think this has a lot to do with manufacturing being relatively weak right here. But you can see real retail sales also down by 7 straight periods here. We have some housing information. So, again, something else that you look at and you say, you know what, this year hasn't really been that bad, and housing has decelerated. We've talked a lot about housing over these months in these charts, and there's charts that have been, maybe a little bit more encouraging than others, but we knew we were in for a reset, and we did get it, but the declines relative to history have not been, frankly, that pronounced. And what's interesting here is we've seen, if you're a closet economist and or anybody that's taken economics that knows your supply and demand curves, we've frankly have had both supply and demand come down. Obviously mortgage rates close to 7%, and then we've got 60% of homeowners with mortgages that have rates that are below 4%, and so they're very non-inclined to want to add supply into the market. And so you've got affordability low, you've got the desire to sell low, which is putting a lid on mobility, which is causing what you see on the right, which is the number of homes for sale is it basically dropped to its lowest point on record. And so when you have both supply and demand go down at the same time, your equilibrium point moves in tandem. And so that's why, frankly, the housing market has not been in that terrible a shape, and it's maybe given some people a little bit more comfort, I guess, or confidence, if you will, heading into the second half of the year. Here we have the fixed mortgage rates, as I mentioned, moving up higher than 7 here. Let's talk about economic growth expectations, and I actually pulled this out of Goldman Sachs, and so they tend to be an outlier. So this represents kind of the mainstream in the red, and then Goldman's view in the blue here. And so they're now looking for a 25% probability of recession, and you do see some investment firms like Goldman kind of becoming a bit more bullish on things, if you will. If you assume that 25% economic or 25% probability of recession is bullish, but the market is still somewhere around 65 to 70%. And I think, the truth lays somewhere in the middle, as far as like, do we hit a recession versus a soft landing? I think it is absolutely in the cards that we hit a soft landing. The question is, with all of these cross currents, how soft is that landing going to be? And so this kind of represents, some of the divergences of opinion, which honestly I think are healthy. You'd hate to have, like groupthink, everyone coalesce around one thing that could be wrong, but this shows the value of independent thinking, and tells me that the cross current of data is really getting people thinking about the near term future here. Well, now we want to talk about student loan debt. And so you can see here that the overall student loan debt has grown by 1 trillion since 2008. I kind of bring this up, one, because I read a really interesting piece of research from S&P Global, but also we know that two things have happened. Obviously, the Supreme Court has struck down President Biden's desire to want to provide forgiveness. And the other thing is that in the latest debt ceiling agreement, the abeyance for student loan payments has gone away. And so, we have $1.6 trillion of federally guaranteed student loans out there. And that represents about $38 billion of payments per year on that debt. And so when you think about the impact there, it's appreciable. It's not overwhelming, but it's probably about 0.2% of GDP. But when you look at the people that are impacted, and we have some charts here that obviously you've got delinquencies for people that are age 18 to 29 on credit cards. It's gone up more than 3 full percentage points year over year, and that delinquency over 90 days for 18 to 29-year-olds is about 8.3% for credit cards. And you think about autos, that delinquency rate is now 4.6%. These are over 90-day delinquencies, and that's the highest that we've seen since 2009. And these are the people that you're counting on to make these payments. And granted, people are going to pay their car payment well before they pay their student loan back. But if you are asking them to add an additional $225 to $275 a month to their budget to pay these loans back, that's going to have an impact on consumption, because we have seen a lot of consumption here. And so it's also worth noting, kind of to preface these next few charts, that with credit card balances moving up, that's not the only issue there. We're seeing delinquencies move higher, but we're seeing credit card carrying interest rates at their highest rate that we've seen in a very, very long time. And so I don't think enough is being made on the whole credit issue. Student loan debt is just one component of it, but it's going to be, as we get into August, September, it's going to be the next shoe to drop in terms of the risk factors to the economy. Here we have that histogram looking at where the age groups of those who hold student loan debt. And you can see vast number of 18 to 29-year-olds, and we talked about the credit issues there. And then, but most of the people that hold student, or the majority, or I guess the largest age group rather, that's the best way to say it, that holds student loan debt is in that 30 to 39 category. And it's worth noting that in addition to the stats that I gave on the last slide, when you think about 90-day delinquencies on credit cards for that group, for the 30 to 39 group, that's 6.3%. That's up over 2% year over year. And auto loan delinquencies are about 3.1%. And so it is important to note that these two very primary prime age working groups that have taken the opportunity for these last several years to use cheap financing to support consumption, that they're going to be hit with a little bit of I call it at least a soft sledgehammer coming up. And as we talk about the ability to, make payments on obligations, we talk about credit quality and so on and so forth. At the consumer level, we've got personal savings rates that are pretty low, and they have upticked a little bit, really over the last year, but they still remain well below pre-pandemic levels. And let's talk about credit for a second and kind of put a bow on that conversation. So this is the chart that I was citing the data from, just put into nice colorful lines for us. But directionally, you can see everything that I'm talking about, whether it's auto loans, credit card delinquencies, et cetera. They're all moving higher at a point that, a lot of these these age cohorts are going to be slammed with extra payment obligations. Here we have some information on the market, and here is some data that I think is worth paying attention to. I mean, you look over the year to date, first half of the year, volatility has been really low, and then S&P 500 earnings growth has actually been slightly positive, and that's not something that we would have expected coming into the year. And as we talked about a few slides ago, profit margins have been a little bit better than expected, even though they're coming down off their peaks. Here we have the NASDAQ 100 forward price to earnings ratio. You can see how that's moved much higher because we have had the tech companies that have kind of carried this banner of artificial intelligence this first half of this year, have been high flyers, and the rest of the market is, has been kind of dragged through the mud a little bit. But if you overlay that with the 10-year TIPS yield, which is the real rate of interest, you see that that's, fallen off a cliff here. And, and we've been watching that actually play out for quite some time, that this relationship is pretty strong. And if you believe in this relationship, and this data series goes back to 2018, but the relationship holds for a lot longer than that, that the market is really kind of overvalued at this point. And so it's due for a pullback. And I'm not saying it's due for a pullback because recession is like going to happen tomorrow. I'm saying that there's a pullback because these valuations are out of line right now. Here we have S&P 500 earnings growth overlaid with the ISM Manufacturing. And we know that the ISM Manufacturing has been weak. It's been below 50, which represents contraction. You can argue that we're in a manufacturing recession, so on and so forth. And I told you before that ISM Manufacturing is actually fairly meaningful in terms of the expectations for stock market activity. And you can see these relationships really tightly represented here. And so, if you assume that ISM Manufacturing is going to be tough for a while, then yes, you should expect S&P 500 earnings growth to be sluggish as well. And we really haven't seen that play out. The sentiment from the investment world is that that earnings are better than expected, and there's not a sense of panic there. But I mean, clearly looking at this top chart, you would expect more distress in earnings to begin to manifest itself. And then here you have below is 12-month forward sales overlaid with that ISM Manufacturing data. And again, if you believe these relationships, which track here in this chart back to the beginning of this current century, then you would expect sales to go down as well. This chart really represents the disconnect that I see between the investment markets and the overall economy heading into the second half of the year. And if there's something that is going to get the bubble that's going to get pricked, so to speak, I think it's perhaps going to be this investor optimism, because you see earnings growth expectations over the second half of the year moving higher. At the same time, you see economic growth projections going down. And I think, the data is, I think, fairly clear that the economy is going to slow down, right? And so, as we've talked about for many slides here today, that the expectations are kind of there's a growing gulf. Is it going to slow down a little? Is it going to slow down a lot? But everyone thinks, okay, well, it's probably going to slow down. History tells us that that's what happens when you keep raising interest rates. And are we going to have a policy mistake? So on and so forth. So that part is relatively understood. And I don't think there's anybody out there that's expecting the economy to accelerate. However, if you look at the investment world, and we just talked about profit margins, we talked about the impact of positive real wage growth, putting potential pressure on margins that are already in kind of a trend line decline. How is that going to help your earnings picture and we just saw this in the ISM Manufacturing overlay with both sales and profits, that the trend line shows a deceleration, but here you've got more optimism built into these earnings estimates that I think just have to be tempered somewhat going forward. And I don't think you can go into the second half as an investor kind of tone deaf to this data in this chart right here. Let's talk about valuation for a second. Here we have the valuation relative to long-term averages. This is a forward price to earnings ratio. And you can see S&P 500 trading at 19 times. Actually, it's perhaps a little bit closer to 20 after the more recent activity that we've seen. And granted, the S&P is being drug along this year by the kind of, I'll call them the Fantastic Seven or whatever they're calling them in the market. These technology stocks that are kind of moving because of the artificial intelligence banner. But you see the 20-year average is about 15.5. So call it 16. So clearly we're overvalued from that standpoint. We talked about that several slides ago. Feel like the market is overvalued. Then you got the equal weighted index, and that 20-year average is actually higher than where it is now. So you'd argue that the bulk of the market is actually not overvalued, and so that's why this is one reason why I think having allocations into equities is not a bad thing, even if you feel like the economy is slowing down, because over a longer period of time you're still at a valuation differential to longer term averages. Except for those high-flying tech stocks, basically. You got the mid caps there, 13.7 versus a long-term average of almost 16, and then you got the S&P small caps, 13.5 relative to a long-term average of about 16.5. So again, having allocations to more mainstream companies and both mid and especially small cap stocks over a longer period of time. Again, if you go into it with eyes wide open, understanding that maybe near term is going to be a little bit in flux, and maybe we have a little bit of a pullback in the market, but there is value there in these areas. We have retail investors that we know coming out of the first half of the year really trying to chase returns. It's very common. It is one of the most often cited behavioral biases out there, that the fear of missing out is very alive and well in the equity markets. And you can see retail investment has really been trying to chase these results here. And this sentiment can be fickle at the first sign of some type of a distress, or what is probably going to happen is if we have like a 5% correction, you're going to see these retail investors race towards the exits. But right now, retail inflows are very, very strong. Here we have developed markets and emerging markets relative to the S&P 500. So just as we were just making a case for long-term investment in small caps, mid caps, and equal weighted S&P 500 domestic equities because of the fact that those areas are undervalued relative to their long-term averages, you too can also make a case for international and emerging markets based on the same principle that relative to US markets, these areas are exhibiting a lot of value right now. The question always is, do you have a catalyst for that value? And I think in a lot of these cases, maybe not so much, but you don't want to be underrepresented in these areas because, more often than not, the valuations differentials at some point are going to correct and mean revert to longer term averages. And you're not going to have the real time data that's going to tell you when that inflection point is and to allow you to time that properly. And so, generally people miss that turn and then you get caught with the thing that we were just talking about in that last chart is that you got the fear of missing out. And so you have trades that crowd after the major move in these areas has already taken place. And here we have the yield curve around recessions, and this represents data going back to 1945. And so this is we've talked a lot about the yield curve being very inverted, and it is more inverted than it's been in a while. And so typically that made that, I call it that peak in the negativity of the yield curve is usually about 6 months before a recession begins. And so if that's true, then maybe a recession begins at the end of this year, beginning of next year. Again, this is historical data. Is just applying historical data to some common sense observations that we're making in the market. Again, it may be that a lot of these things that we're seeing with like the leading economic indicators and then the 2-year to 10-year yield curve, maybe they may be false positives. We don't know yet, but this is just one more indicator that tells us, typically when you see this, that you are at least going to get economic slowing 6 months forward. That's all we have this week. Hope you've enjoyed the chart pack. A little bit of meat this week, but hope you've enjoyed the presentation, and we'll look forward to seeing you again soon. Take care. Bye.